And I think the interesting thing about the neobanks for stablecoins is that you can offer the same yield product to anyone in the world effectively for the same rate, right? Like none of these other products that your neobank or fintech kind of currently offers are really that ungeo-blocked, like can really be that equal.
This is Money Code. It's a show where we decode stablecoins and programmable money so that you can better prepare for an on-chain future. I'm Chuk, Okpalugo, your host and author of Stablecoin Blueprint, and I'm here with my co-host Raj Parekh, head of stablecoins and payments at Monad. How's it going, Raj?
Another action-packed week in the future of programmable money, so I'm excited.
Excellent. Raj is gearing up for Monad's mainnet launch, which by the time this episode comes out will probably just have happened. So really exciting times here. And then we're very, very, very excited today to be joined by Tarun Chitra, the CEO and co-founder of Gauntlet and managing partner of Robot Ventures. Great to have you today, Tarun.
Excited to be here.
So before we dive in, a quick note. Money Code is brought to you by Stablecoin Media and powered by BVNK. The views and opinions of the hosts and guests are their own and may not represent their companies, and nothing we discuss today constitutes investment advice or any other form of advice. Okay, so let's dive in. So I think our audience is very mixed. We come from payments, some finance, some crypto, some builders. They may not necessarily be familiar with Gauntlet. So maybe you can give us just a quick backstory of how you started Gauntlet, what it started as, and what it's doing today.
Yeah, so I think for many people in potentially listeners of this podcast, or even people in crypto, we're a little bit of a dinosaur age-wise. We were founded in 2018, which in most of the time people are like, people were doing this in 2018. So I think we've kind of been around for a while. But basically, the premise that Gauntlet was founded with was my co-founders and I, we were all working in quant trading, and we were watching things happen during the ICO boom where people were making all these protocols, they're making new L1s, making new chains, and they were really rigorous about the cryptography. They're like, here's exactly how much compute you need to break this thing, or in this distributed system, here's like the number of nodes you need to compromise to attack the network. But they were not very kind of rigorous about the economics, right? They would just be like, oh, we're just going to copy Bitcoin's transaction fee policy, or we're going to copy Bitcoin's inflation curve. And it was sort of weird to read these things because there's like this duality of kind of reading these things where it's like one side is like really rigorous and gives you very concrete guarantees. And the other side's like, we're making this network that has 10,000 times the supply of Bitcoin, but we're going to charge you the exact same economics as Bitcoin, right? It doesn't totally make sense. And so I think at that time, this was before, DeFi was like decentralized finance was a term. I think, USDT probably had 98% market share then, 97% market share. Like USDC was just getting started, and USDC sort of needed DeFi and decentralized finance to grow. So in the stablecoin landscape then was USDT, and then a bunch of failed algorithmic stablecoins like BitShares and things like that probably a lot of your listeners maybe never have heard of and would be better never hearing of again. And so our goal was to try to figure out how to make software to stress test these systems like the way you would back test a trading strategy or stress test a financial model against these new systems people were making. Now, there are a lot of idiosyncrasies in decentralized systems. You have to model different types of agents in the system. Obviously now, everyone talks about multi-agent modeling, but in 2018, that was sort of like a thing where it was like, okay, yeah, that's a research thing, right? That's not like a thing used in practice. But, at that time in some of the fields we were working in, which were quant finance and self-driving cars and other places, people were doing multi-agent modeling to kind of get quantitative estimates of rare events, like tail events, like when something really blows up or something really bad happens, what can you expect out of a complex system made of many actors? So we started as a company that built simulation software for doing this. And I would say our early days were like the Palantir of this stuff, where we had the simulation software, but then we go to our customers who are people building protocols and people building stablecoins and people building chains. And we would sort of use our software to stress test and give them sort of like, here's where your thing breaks, here's where it doesn't break. I think part of the reason we kind of got started was I was doing this as consulting. Someone tried to buy my one-person consultancy, and I was like, okay, well, clearly there's someone wants this type of software. It's just unclear how you monetize it. But over time, it's sort of, we kind of went from this more custom consulting model to a more SaaS model where people were paying for parameter updates, like what should the interest rate be in this protocol under some conditions? Or what should the loan, if I'm giving you a loan, what should the loan to value ratio be? Stuff like that. And then sort of since February 2024, we've kind of got into vault curation, which is a sort of form of on-chain asset management. We had $0 in February 2024 under management. We have a little over 2.1 billion today. So yeah, hopefully that was, I try to summarize 7 years in 30 seconds.
Right. No, that's great. And I think starting with simulation-based risk analysis and assessment, I think the key theme here is risk management. And when we talk about finance and capital markets, these are the key areas. And so you mentioned, okay, now since Feb 2024, you are a vault curator. Okay, so that's going to blow people's minds. Vault and curation. Okay, what does that even mean, right? I think we can do a bit of a quick kind of framing of where this all fits in within DeFi. And DeFi, we said, decentralized finance. There are lots of different areas of DeFi, and I think people are very familiar with exchanges, trading, right? There's centralized exchanges and there's decentralized exchanges. And then there's this kind of lending and borrowing, or capital provision and capital allocation, where there's some people who want to get some earning, so they give their money to somebody else, and then somebody who wants to go and deploy that. And that could be, I want to go borrow it for myself. I need to go and make a trade or make an investment or do something else. Or essentially an asset manager who takes that capital that people have provided to earn a yield, and you go and deploy it in different places. And I think there's a very, I say asset management because that is a very kind of clear TradFi kind of analogy there, where the role of that player in the ecosystem is to make a return for the investors. And now we have a way to do that on chain. And parts of it are on chain and parts of it are not quite on chain. And so vaults are essentially these funds that are managed by these asset managers, and these asset managers are the curators. I've made a bunch of, smoothed over a bunch of things there. Maybe you can help kind of unpack, how to think through this for like a TradFi audience.
For sure. I think maybe I'll give some historical analogs first before we kind of talk about sort of the current state. So my view in the history of finance is that every time there's sort of a new technological revolution in financial products, there's always this sort of gestation period where people are spending time trying to understand how the products work, understand the risk models, understand when they break, and inevitably you can't understand when they break until some rare bad events happen. And then from there, kind of building up modeling to figure out, okay, like how would I actually, own these assets? How would I utilize them? How would I scale them? And if we look at the 1980s, I think there were two strains of kind of this, starting with risk management and then turning into asset management types of companies. The first is BlackRock, so sort of pre, the municipal bond and junk bond kind of revolution in the 80s. BlackRock was sort of serving as a risk manager and providing sort of risk recommendations for people who are participating in this market. And then that sort of turned into them running funds that were investing in fixed income in general. And so, on the sort of fund and fixed income side, there's sort of this natural tendency of people who are doing kind of the risk management to become asset managers, right? Because in some cases they don't. In some cases they stay like credit rating agencies, and they kind of never cross the chasm. Another place this happened was in quant finance, where, the kind of old school statistical arbitrage funds, so AQR, D, Shaw, my old employer a long time ago, Renaissance, etc., they like started by actually doing a lot more research into these different products before they were trading. So I think there was kind of this, again, this gestation period where people spent a lot of time doing research and understanding these things before they went trading. Now, in the case of like BlackRock and AQR, they spent multiple years, in AQR's case, probably multiple decades, writing a lot of academic research papers on like idiosyncrasies in these markets and making these markets a lot more easy for people to understand. Because at the end of the day, why are you making a risk model? One is to protect your own assets and responsibly invest. But the other is also a form of education, in the sense of like, if you're an asset manager, having, the investors in the product understand sort of what types of risks their capital is involved in. And research and transparency is actually quite important to that. And actually what you saw from the 80s technological revolution to now is like they started very transparent, and then over time it kind of became less transparent. So I think you also saw in the kind of low latency electronic trading in the early 2000s, you saw a similar kind of framing from research to production. And I would argue that decentralized finance since 2019 to now has had a similar thing. And so one thing I think Gauntlet, at least among people in decentralized finance, is probably most famous for, is we've sort of written some of the most highly cited academic papers on how you should write the math for these things, what the risk model should look like, what math is wrong, things like that. And the reason I bring up this analogy is there's always this kind of natural thing of like, you can't manage a large amount of assets for a very long time without having a good risk model that's robust to large shocks and large market conditions. But it's very hard to make that risk model a priori without the data happening or without the events happening, right? It's like me trying to write hurricane insurance on, Louisiana in the 90s. Like, sure, I could have collected premiums for 10 years or 15 years, and then Katrina came and completely wiped me out. And no amount of research I did until I got that event would have helped me price that correctly, right? So there's sort of this analog that you do need these rare events. So oftentimes it makes more sense before you're putting capital at risk to like spend time really honing your analysis and risk model of these systems before you apply them in production. So I'm building this analogy to kind of say that vault curation, the concept of vaults overall, grew out of watching the early DeFi protocols evolve over time and then have some rare and bad events. And then from those bad events, people started to figure out, okay, we need these types of risk controls, or we need these types of mechanisms to make this safer for different types of assets. So, if I kind of describe decentralized finance's history, I mean, before defining the history, I should maybe say the goals. So the goals of decentralized finance historically have been, despite crypto starting as this decentralized revolution where anyone could, run a node themselves or use their own wallet and self-custody funds, the empirical evidence is a large majority of users use custodial products, right? They use Coinbase or Binance, and they keep their assets there. And there's a lot of really good reasons to, right? Security-wise, maybe you're not going to be trained to do something. Some of them offer insurance, some of them offer better yield. There's a bunch of different reasons. But every crypto cycle that I've been in since 2013 has always had this thing where like there's some centralized entity, accumulates a lot of assets, has some blow up, whether it's Mt. Gox, whether it's all the random Korean exchanges in 2017, whether it's FTX, there's an entire history of this. And so decentralized finance is almost like the reaction to every one of these blowups. Like every time something bad happens, the reaction to the 2017 ICO boom was like, oh, the exchanges are controlling all the listings. Why do I need to like launch my token on Ethereum, a blockchain, but I can't trade it on Ethereum, the blockchain, right? I have to like go to Binance. I have to go to this centralized entity. And so decentralized finance has always been take all these things that people like to use in a centralized manner, find a way to do them decentralized. So there's permissionless listing or permissionless borrowing or permissionless lending. So like the gatekeeper of the exchanges can't tell me you can't do this thing, but also find a way to make it as safe as doing it there, right? And there's sort of this paradox there. Like, can you even do that? And what we found over time is people have gotten much more accustomed to some hybrid model of this, right? And the hybrid model is really important because if I look at FTX, one of the problems with FTX is I couldn't watch where the money was at any time, right? And so then I could never know if I could fully withdraw my money. Whereas these hybrid models give you transparency into where the funds are and what they're allocated to. But they maybe don't kind of reveal the exact algorithm that's doing the allocation, right? So they're separating sort of private data from public data. And I would argue that vaults are a structure that is built around this principle, which is there's sometimes private data that you need. If you want to optimize yield, it's a competitive marketplace. And the best way to get the best yield is to have this marketplace where people are trading risk or trading reward competitively, but that means they have to have some private information. If it's fully public, it's kind of, you're not going to get the best pricing. And sort of that's what the DeFi 1.0 protocols were, was everything was public, everything was transparent. So then the pricing was always more inefficient than the centralized markets where, you know, you as a trader or user could keep some information private. Vaults came out of kind of a practicality of we want to be closer to centralized exchange performance, but we also don't want FTX style, you know, behavior occurring. And so they naturally serve as a form of funds where users can non-custodially deposit funds into this vehicle. And there is a manager, a curator, in the parlance of Morpho, but there's actually many vault protocols, so, and they all have different names, but in some ways they're like different types of on-chain asset managers. But I'll use the Morpho terminology since they're the largest vault protocol. And these curators have some private data of a strategy of how they're determining where your funds get allocated to. So like maybe there's, you know, 3 yield opportunities. One is earning 5% and has some risk. Another one is earning 10% and has more risk, but it's not clear how much more risk. Another one has 3%, but low risk. You know, how do I allocate my money to those 3 options? And the idea is the curator is themselves computing a risk model and then deciding how to allocate and then, you know, charging a performance fee for that. And so in this sense, but the curator never touches the funds themselves. The smart contract completely custodies the funds and allocates to the markets, as they say, but the curator never themselves has custody of the funds. And I think this is one very big difference between a vault and a normal fund. You know, when you subscribe to a normal fund, you're sending money to the fund manager. And the legal system prevents the fund manager from investing in all sorts of stuff. And maybe auditors and like this kind of other kind of ecosystem around that. But fundamentally, you know, the custody is held by the fund manager. And so I think that's a very large difference between vaults and normal funds, is that the smart contract is always holding the funds and you can see where it's allocated to and you can withdraw or deposit. The thing that's not private or the thing that's not public is how it gets allocated. And so by separating these concerns, the goal is to give users transparency and comfort of where their assets are and the ability to withdraw them, while also allowing for private strategies that don't get kind of commoditized or don't kind of get worse prices than centralized venues where everything's private. So I know that was like kind of a long explanation, but
no, I mean that was awesome. I mean, it was a great breakdown, and maybe just to unpack that further. But you mentioned like I think a couple of really cool principles. I mean, the first principle of like maturation, right? I mean, we started, you know, around, you know, DeFi summer. You could argue like, you know, about 4 or 5 plus years at this point now. But battle tested, has seen a lot of ups and downs as a byproduct of that, and now where we are today is a hardened system that we know works, and it's transparent and immutable by code, which is really interesting. The second principle I think you mentioned is, you know, what I think of as like a new platform for money, where you know, historically you've had a bank or some type of custodian or fund manager that was managing funds. Yes, there was some built-in compliance or, you know, some legalities around it, but the transparency was really up to the fund manager, you know, making that information available for you. Now with these new systems, you're leveraging, you know, immutable, you know, smart contracts. There's transparency built in with a distributed ledger as well. So you can see everything as an entity or as a user. So if you see something that's like not going in the direction you're interested in, you're like, well, maybe I don't want to participate in that fund anymore. And you can actually do it a lot faster. When, you know, beforehand, if the fund manager was going rogue, it might be too late before you can actually like take your money out at that point too. So there's a lot of interesting principles here when we are moving into a new platform for money where it's transparent. There's a lot of flexibility, whether you want to go in and out of those strategies as well. And there's also a multitude of different strategies at the same time too. So there's a lot of optionality built in. And then you mentioned one thing that's really interesting around these hybrid models. Maybe if you could describe one of the more popular hybrid models we've seen is actually like Coinbase and Morpho as an example, or what commonly folks in the fintech world call a DeFi mullet, where you have some type of smart contract or protocol that's used behind the scenes, but you're providing some type of either high yield or like fintechy service in the front. But maybe talk about just like the evolution of where DeFi has come, where it's now being accessible through platforms like a Coinbase or a fintech, and how that's actually like a huge way of actually accessing some of these systems also.
Yeah, I mean, I think fundamentally in finance, there's always kind of been this separation between public information and private information. Like prices of stocks are public, but people's particular holdings are not public. And I think blockchains obviously provide a really good substrate for the public piece. But if you force everyone into the public piece, you also have this kind of lemon adverse selection problem where like everyone who has to use the fully public revelation, like I'm revealing my whole portfolio, I'm revealing all my investments to you at all times. There is a bit of a lemon problem for them as an individual, right? They can get front run. There's a lot of adverse selection. They're telling the market like, oh, there's someone who owns 20% of this asset who won't sell it faster than the centralized exchange, right? Like there's a lot of information that's there. And I think the natural evolution in finance is always this tension between what is public and what is private. And like, if you look at the evolution of the rules on public traded stock markets over time, where there was full public, order books, and then all of a sudden certain order types were not public, and then all of a sudden other order types were public eventually. There's this evolution of this like tension between how much you want to make truly transparent that makes it efficient to quote and make a market versus how much you want to keep private, like someone's individual portfolio or someone's individual balances is kind of always in tension. And I think this is certainly what you're seeing in stablecoins right now, where, as both a crypto investor and someone who's just sort of been around crypto for a long time, the value of privacy has always been, I think paramount to people who've been in crypto for, a decade plus. But in some ways, it never really was tangible to the average person until they had to use stablecoins, where they were realizing that they're telling the whole world their balance, or they're telling the whole world they bought an embarrassing meme coin. And, now people are, I think, kind of realizing like, hey, there's some things I want to be public because maybe if I'm public, I get a better price. But some things I want to be private and not reveal all my investment decisions. And so I guess I'm belaboring this point just more so to kind of give an idea of like different user preferences. And there are users who are really large whales who actually don't care that much about their privacy, in the sense that like they're so large that yes, they care, they get front run on some transactions that are small relative to their size. They don't care, but they might really value the self custody because they don't want their assets to be somewhere that might be another FTX. On the other hand, when you think about the average user, right? The average user who's like has a few $1,000s in a bank account, they want to earn the maximum amount of yield, but they really, really want downside protection. Like they can't afford to lose it. They want to be able to understand how to do that without having to do the math themselves, or without having to figure out the allocation themselves, and without having to like get front run a million times and lose money to realize that, oh, they did the wrong investment decision. And there's just a natural thing for that part of the world to want to invest in a fund or invest in an ETF or an semi-actively managed vehicle that takes care of that for them, right? And in U.S. equities, you've seen this like just dominating trend over the last 10 to 15 years where there are more ETFs than single name stocks now, right? And like people would rather have these kind of managed portfolios. Mm-hmm. And vaults are really built around that premise, that there is a notion of a managed portfolio that can also be squared away with the crypto values of self-custody and ability to withdraw, ability to exit. Because fundamentally, I think of all the kind of original cypherpunk values of Bitcoin that exists, the one that DeFi does really value when it's real DeFi is the ability to exit. Like, I can look at my money and I can, I don't like a decision being made, or I don't like something that's happening on chain or something in the market that's weird. I can exit whenever I want. And I think the right to exit is something you need public transparency for, but the right to have optimal and safe yield might not be something you want fully public, right? And so vaults are trying to balance those two. And I think from the fintech point of view, fintechs have been used to sort of being forced into this separation. I think about a fintech as a front end for a, I don't know, bank in the Midwest that is doing all their banking, and then they're kind of handling, maybe they do loans over the weekend so that their end user doesn't know that, like, actually technically their money only moved Monday morning or whatever, right? The fintech is kind of keeping a lot of the data private, like the metadata from the bank. Like, they're not necessarily telling the bank, oh, this user bought, Robinhood isn't telling their correspondent bank, like, oh, this user bought these options over the weekend, but they are telling them, like, hey, this is their balance on this exchange. Like, okay, like, you can go read it, and then if they're doing a credit card transaction, using an interconnect like Plaid or something, we can all be confident. All the parties involved can be confident, like, this account has enough money. And that is this exact same public versus private separation. And I think DeFi to a lot of fintech companies for a long time has been scary because it's like everything's public. Now there's no way of kind of doing the separation that you're used to. And I think the vault model, as well as just smart contracts that separate public and private, I think to me, that's the fundamental essence. That is what enables you to do this thing where you give the customer experience and user experience that people expect from a fintech using kind of the private off-chain side, but use the public side to provide these guarantees on integrity, on ability to exit, on sort of knowing where your assets are. And those public guarantees allow for all the efficiencies I'm sure you guys have talked about in stablecoins in general.
Yeah, I think that's a nice way of putting it. It's not kind of transparency at all costs. You need to get this right balance of what information needs to be private, what information needs to be public, so that you can produce these products. And when you mentioned the actively managed funds and actively managed assets, it kind of points me to the fact that this is just the on-chain version of, like you said, ETFs, even platforms like Wealthsimple and Wealthfront, where the user says, look, I just want this kind of risk with this kind of reward. I don't want to do all of the heavy lifting of rebalancing and investing and tracking the market. I want someone to do it, but I want a choice of what kind of risk balance that is. And so this is a decentralized way of achieving that same goal with the benefits, like you mentioned, of sufficient transparency to guarantee some of those kind of key things, the ability to withdraw, and the fact that you know where those assets are. And so I think that's a nice way of putting it. And I think to tie it back, what should listeners and folks in fintech, builders of financial products, take away as the kind of the implication? I think the Coinbase example is a good one. Hey, I'm building a consumer application. I can now provide my users with a full range of financial products. What yield do you want? Do you want risk-free rate? Great, I've got you. Do you want something that's a bit more risky but has some downside protection? Here's another one. And then the ability to kind of borrow against your assets. What are the kind of real world kind of implications are there for the builders of today?
Yeah, so I think, one really important thing about the lending market, just to give more of a microstructure view of it, but not like at the technical level of like what the smart contracts are doing, but more just like a supply and demand kind of description, is the lending markets in DeFi have evolved a lot over time. And I think if you understand the history and then understand how we got to where we are, it's a lot easier to understand why it might be super interesting to people now. So the original kind of DeFi lending markets were actually because there weren't really great centralized lenders even in 2018, 2019. So like Compound and Dharma were, and then of course a bunch of ICOs, including ETHLend, which became Aave. They they all were kind of focused on this idea that the only exchanges who were lending were like kind of sketchy, and you couldn't really figure out if they had your collateral or like when you borrowed from them, they just took your collateral, and there was no transparency. 2018, Ethereum was going down because of CryptoKitties, so it was not like you could really even do a lot of super great inspection. And at the compared to swaps, if I look at decentralized exchanges for spot trading like Uniswap, there it was very obvious what the product was. Like there was a centralized product, and I want to make a decentralized version. Kind of. In the lending case, there was a lot of like OTC lending. There was a lot of, I would message someone and ask them if they wanted to do a loan with me. But there was a little less like organized lending outside of exchanges lending or at that time Tether lending. And so there wasn't quite this thing of like smart contract, the idea that like decentralized lending would exist in the form it does. So most of the initial usage of DeFi lending in 2018 and 2019 was a lot of people who were Ethereum whales who, Ethereum went from like, near, $1,000 to $80. And a lot of them just borrowed USD stablecoins, or they minted DAI like in MakerDAO as a way of sort of hedging their Ethereum exposure. And so the initial kind of demand for lending was quite low. It was like a home equity loan. And if you look at, the US, for instance, in terms of lending, one of the most over-owned assets across the US, so this is not like picking a particular state or jurisdiction, just like average over the US, is homes and people's equity in their homes. But one of the least borrowed against assets is home equity. Like people really don't borrow against it compared to other things they borrow. They borrow in other ways against their income, against other hard assets. And in some sense, DeFi lending started as like a home equity loan. Like I accidentally bought into the ETH ICO, that's my home, and I was borrowing against it. But everyone's very risk averse, so it wasn't like super aggressive lending, and that means there wasn't that much yield being generated. Fast forward to DeFi summer, people were borrowing because they're like, oh, I need to borrow this token to try to do yield farming and earn yield in some other asset, but I don't want to sell my assets, so I'll borrow instead. By 2022, what had happened was crypto finally started having yield-bearing assets. So the Ethereum merge took place in October 2022. And that's when Ethereum moved from proof of work to proof of stake, which meant that if you owned Ethereum, you could stake your Ethereum and earn some yield, 3 to 4%. And once there was positive yield to an asset, now, of course, other assets had already had staking yield, like Solana, like Near, like there was a ton of staking coins, but they didn't have really well-developed DeFi ecosystems, nor did they have a lot of stablecoin liquidity at that time. Like Ethereum still, obviously today it's still quite dominant, but it was even more dominant then in terms of stablecoins were really all on Ethereum. And so once you had yield-bearing assets, you started to see the demand for borrowing bifurcate. So you had one side of the market that was like, I'm a whale, I own a bunch of assets, I'm just borrowing some USD to pay for expenses or do whatever, make another investment. And on the other side, you saw people who wanted levered yield. So they were like, instead of getting 3% of my Ethereum, what if I borrowed against my Ethereum and got 5%? Because I borrowed 100%, but then I had to pay a 1% borrow cost, so I got 5%, 3 plus 3 minus 1. And this leverage yield market grew a lot because it kind of made Ethereum yields more attractive in general, and that created a lot of demand in the lending market. And the reason I bring this up is a thing I kind of see right now in the tokenized asset world is like a lot of people who want to tokenize assets that don't have natural yield. And to me, they remind me of the early days of DeFi. Like they're like, you're tokenizing a home. I mean, not literally, but like metaphorically. And like people are afraid to borrow against that asset aggressively. They kind of are risk averse. Whereas when people are like, oh, I see this yield, what if I could get a multiple of that yield? They're willing to borrow more aggressively and generate more demand. And so I think thinking about yield-bearing assets coming on chain is actually more valuable than thinking about kind of hard assets that don't have yield, which I know is sort of against what people in crypto think, right? They're like, Bitcoin is gold, so like all our assets should be gold. But if you look at the DeFi lending markets, they have really a lot of the demand side, because the supply side is very elastic, right? Like if there's demand, there's enough on-chain capital, stable coins, and ETH and SOL that will follow that. And the role of a curator is matching that, like matching the supply and demand in some ways, right? That's what the asset manager is supposed to do. So like assume that stuff is getting more efficient over time and has gotten relatively smooth. Then the question becomes like, where's the demand coming from? And the demand is the yield-bearing asset side. And I think that is where, if you're thinking about being a fintech where you want to get your users kind of using this stuff, people will let you borrow against yield-bearing assets on chain, generally speaking, cheaper than off chain. And so if you are a fintech product where you have margin or stock loans or other types of yield products for your users, and you have users who want to earn 1.5 or 2x times that yield, this is the perfect market for that. So that's sort of, I'm giving the history lesson more so that you can see that like it actually took, crypto had to develop those assets for this market to grow as much as it did.
No, it makes a ton of sense. A lot of the maturation story that you're talking about is like, I think, important detail too, because again, it goes back to like how robust these markets have become too. But I guess like maybe one thing, if you can maybe break down a little bit more, there's a multitude of options out there. If I'm a fintech builder today, let's say I'm launching a neobank today. I might have a high yield savings account where it offers the risk-free rate. Maybe it's 3 to 4% on deposits. But my users are kind of bored of 3 to 4%. They're like, well, I want more, but obviously the trade-off is going to be more risk. In that case, like, what are the options for a fintech builder to say, hey, and maybe you could describe like even the traditional finance options versus DeFi as well. But if they wanted to, leverage some of the primitives that you're mentioning, like what is that option for them today?
Yeah. So, I will maybe now I'll give it a little bit more of the view of the Gauntlet vaults, just more because like we kind of have tailored our risk tranches more or less based on like, we have a lot of fintech, clients and users of these vaults where they're a neobank or they're some type of entity and their users have stablecoins and they're depositing in these vaults for yield. We sort of think of it in 3 tranches. So we think of a tranche called Prime, and Prime is like basically risk-free rate plus a little bit, like risk-free rate plus 50 basis points to 1%. And that the idea is that the on-chain borrowers obviously have to pay some premium to risk-free rate on average, and it ends up being that amount when they're really low risk, like they're borrowing against ETH or Bitcoin at a 10% loan-to-value ratio, like really low amount. This is kind of this home equity loan thing I was talking about. Like there's enough demand for that, but the yield will be lower. Then we talk about Core, which is sort of in the 6 to 9% range. And that is things where there's yield-bearing assets. And so your borrowers are oftentimes people who want leverage on the yield-bearing assets. And you're taking basis risk, right? You're taking the risk that the yield goes down, you're taking some principal risk. But the goal of the curator is to manage that collateral risk for you so that you're not sort of explicitly thinking about it. And so that is sort of a higher risk option, but generally speaking, even then the insolvency rates on those are in the 50 basis points and below, like 10 to 50 basis points rate.
Blended.
So, blended, yeah. So it is sufficiently low that I think it's a relatively safe option, especially for if you have a user base. And then our third category we call, and actually I think we call it core or balanced depending on the protocol. And then finally we have the third category, which is called frontier, which is like trying to get above 10%. Now it won't always, right? It just is trying to find the more esoteric collateral, obviously with a lot of risk balance. And so the way I think about it is lending in crypto, at least with stablecoins, almost always has these 3 tiers. And the main things you need to know are like A, really understanding the collateral you're lending to, and then B, understanding the borrower demand. And the beauty of on-chain loans, right, is I might not know the identity of the user, but I can oftentimes see what they're using it for. And these users who are trying to loop to get, leverage on a single yield-bearing asset, all their actions are on chain. So you can track them and then use that to understand kind of the risk in this. And this is the type of stuff that when you're a curator asset manager, like you're constantly paying attention to, is like your users whose usage you can see, you really try to understand, and then maybe you can offer a more aggressive loan to value, just like a bank does, except you're doing it algorithmically, right? Like we're bidding on the interest rates and loan to value type of stuff implicitly every Ethereum block or every base block. And so I kind of bring this up more because I think in general we got to this framework because fintech kind of different buckets of fintechs, right? You have like the brokerage, like more Robinhood, like their users want as high yield as possible, fine with default risk. You have sort of like the Revolut users who like Revolut offers like every financial product, right, under the sun. And a lot of those are quite a bit higher with more risk, like structured products than, obviously varies from country to country, but then treasuries. And the final is like, of course, the people who like really just want slightly better than treasury, but very, very low risk. And I think the interesting thing about the neobanks for stablecoins is that you can offer the same yield product to anyone in the world effectively for the same rate, right? Like none of these other products that your neobank or fintech kind of currently offers are really that ungeo-blocked, like can really be that equal. And I think that's sort of the beauty of these things is like you're really able to kind of like aggregate across all these different domains. So at least that's how I think about it for pure lending. For other like higher risk stuff, higher leverage stuff, I don't think I've seen that much demand from fintechs, to be honest. I think certainly like crypto exchanges and stuff do want to offer the much higher risk stuff, but probably not. This audience probably is not that interested in that.
And what about for the asset managers, the fund managers, the existing kind of capital allocators? What you've described here is, we're painting a story of DeFi enabling lots of platforms to enable their customers to invest in a range of assets. And I think you elegantly put it into like three buckets that I think people understand well, especially if you go into any kind of investment app. It's like, are you risky? Are you safe? Are you, more risk, and so on. And so if you're in the business of asset management, how should you think about playing in this market? Do you take your existing fund, try and tokenize it, and then go talk to the curators and say, hey, I've got a great fund. Come and buy some of my tokenized fund. Do you try to become a curator yourself? How should they think about that?
Yeah, so that's a great question. So two things. So one is we have done some, they're small vaults. They haven't grown in kind of TVL a lot, but we've done some kind of initial vaults where we took tokenized credit funds and let people get leverage, like looped those funds. So like, one of the funds we did was Apollo's ACRED fund, which I think yields like in the like 11-ish, 12%. And, using DeFi interest rates being sufficiently low, we were able to offer you like a looped version at like 19-ish percent. And I think for funds that are, private credit and have these kind of restrictions where it's like, okay, my distributions are monthly or quarterly. My Oracle, like the price that the on-chain lender gets is, I need my fund admin to provide the thing. You can definitely do it. I just think you're going to get, you will get better interest rates, but I do think the onboarding for users is still not great. Like, I think the KYC procedures are still much harder, and it's somehow that part, the friction hasn't been removed. And obviously there's a ton of people working on that, right? Like Securitize, Superstate, etc. Right? So I would say that the tokenization platforms have not quite, like DeFi is like way ahead in terms of like the things you can do and how you can like tranche things and slice things versus like the tokenization stuff is like, and a lot of it is just like, trying to map the paper world to the digital world, and like it's not fitting. It's like square peg round hole. So I would say like that stuff is still not settled yet. Now there might be some opportunities in that. I think if you have more, call it closer to liquid funds, like daily liquidity, closer to ETF or even daily closed-end fund, that becomes extremely appealing. So if you're a fund admin or fund manager who has like higher liquidity, maybe like medium yield funds, and you have a user base who you think would like to arb the spread between DeFi rates and TradFi rates to get a levered version of that, I think that's like the perfect middle ground right now. Those people are probably more like, insurers or people who like have bond funds, stuff that's like kind of not quite the private credit part of the world where it's like more irregular payments. Now, that's not saying that won't happen, but I think like there's just a little further to go. So the closer you are in the liquidity spectrum to treasuries, the higher likelihood that you're going to be, that's sort of the heuristic you should be using. And the question of whether to become a curator or whether to kind of partner with one, I think the main thing is curation. And to me, I say this is from a personal thing. I think the reason it's appealing or interesting is it's sort of basically like quant trading. Like you have to bid on interest rates continuously. It's like, in the time we did this podcast, we must have bid like, 10,000 times or something, right? Like, so like this kind of quantitative credit stuff has never really existed. When I was in finance, like despite, having FPGAs for executing trades and doing low latency stuff, I still had to call someone to get a margin loan on stocks. It's not fully automated. Like the lending part of the world in TradFi is like kind of half pencil and paper, half like call someone on the phone. Whereas in DeFi, it actually feels like the first time you have like electronic credit markets that are like 24/7. People are trading them continuously. People are bidding on values continuously. And the reason I bring this up is this means that you as an asset manager need to treat yourself like an HFT firm. You can't treat yourself like a traditional asset manager. If you're, you need to be like an ad network, like people who are bidding on online ads 24/7, or people who are in HFT trading globally 24/7. If you are structured like that, then it could make sense to be a curator. But if you're not, I think you're opening yourself up to a can of worms. It's like you have to get the security and custody stuff right. You have to key management right. You have to get the quant bidding stuff right. You have to get all the BD stuff. And so I think in that case, it probably makes more sense to partner versus.
Yeah, I mean, this is like a key reason why we call the show Money Code, because code is, money is now code, and there's a new evolution that, some of these advisors, fintechs all have to kind of realize and kind of grapple with this new reality as well. And maybe just to, as we're getting close on time here, but, if I'm a PM or, I'm an engineer at a fintech today, and I had I was tasked with, I want to enable high yield for my users leveraging DeFi. What would be like the checklist that you would advise like that PM or that engineer to say, these are the 3 or 4 things to evaluate? And you've kind of touched on a lot of these things like as part of this conversation, but maybe if you can break it down, just like what to look for and then how to underwrite that risk as well.
Yeah, so I actually think the first question that is probably the worst, hardest one for a lot of people, because they, I think in the current market, there's a lot more buzz and noise. And so it's like, it's actually picking what stablecoin you want people to use from the fintech side, because not all stablecoins have equivalent yield markets. Obviously, USDC probably number one for on-chain yield market, although honestly, USDT is so close nowadays that I would say like 2020 to 2024, USDC was by far the best stablecoin for on-chain yield. So off-chain, like yield you earn at Binance, yield you earn at Bybit, Tether, USDT wins for sure, hands down. On-chain yield, it was definitely USDC. Like USDC's growth, if you look at the supply curve, was totally early days of DeFi. It was like most of the growth, and because of that, it was sort of the best place to get yield. But Tether's close. So like if you're picking between USDC and USDT, I would say it's kind of a wash. It's your choice based on your geo. Like, you know, obviously maybe you're in a geo where Tether makes like a million times more sense. So I'm not gonna, you know, you gotta pick whatever your users use, right? Now the harder part is if you're like bootstrapping your own stablecoin, because then it's like the ecosystem effect in DeFi is very real. Like you need to have enough liquidity of your stablecoin versus other assets, whether it's other stablecoins or the major assets like Ethereum or Bitcoin, whether it's indirect or direct. You also need to make sure that, you know, all of the kind of the integrations and like wallets and exchanges, et cetera, for your coin exists so that people are actively trading it. And then obviously, like, you know, there's obviously the bridge type and M0 type of worlds where these stablecoins are service, but you know, you're still responsible for building to some extent a little bit of DeFi liquidity. Like, yes, you can convert to the base token like USDB or M, but those are still kind of nascent stablecoins. They're not super integrated into DeFi themselves. Like they exist, but there's not, like, when I say integrated, I mean you can use them and there's yield at, you know, 100 million plus, so that you know, when you're a neobank, you know, if your users are joining DeFi, you don't want to be the biggest you know, depositor in that coin, right? Like suppose there's a stable coin where like if your users deposited, you would be 50% of that stablecoin supply. That's probably not that's like bad concentration risk management for yourself, right? And so in USDC and USDT, I think, you know, unless you're JP Morgan, like you really are fine. Like but obviously if you're starting your own, there's a lot more risk. And I don't think you can promise high rates because you're going to have to incentivize the liquidity and stuff like that. And you will eventually, you won't be able to offer as high rates. I think, you know, PayPal has certainly learned this lesson their first time around with PyUSD, and I think hopefully they're being you know, if you look at the PyUSD chart versus like the days that they started and stopped incentives, it's, you know, you can see where the usage was. So I bring this up because I think a lot of people are grappling with this, right? I went to Money 2020, I think a week ago or 2 weeks ago, whatever, and I feel like I talked to a lot of people who are like, we're in the process of deciding what stablecoin to use. And this is why I'm focusing on this so much, because it seems like people who are in this realm are still thinking about that. I think there's a very big, you know, you're making a very big platform decision when you choose that. And I think USDC and USDT from a yield perspective, by far the easiest. Once you do that, I think the question is just more, you know, given whatever regulatory constraints you might be under, you know, which products can you offer? And generally speaking, I think vaults are nice because curators can make you know, vaults are like funds, like, except instead of an LP agreement, I am writing a bunch of lines of code that calls a bunch of smart contracts. And I can make you a vault that has some constraints that you want. Like, okay, only our users can supply to this vault, or only this type of borrower can be used, or this interest rate caps, or whatever, right? So I generally think one thing about vaults that's useful is this flexibility on configuration that I think the original DeFi protocols didn't have, because they lumped everyone together and everyone had to share the same parameters, which was just is not true with vaults. They can be more isolated in that way. And so I would think about that, like what constraints you have. And once you have a set of constraints, then you can actually work backwards to the set of protocols and then rank them by yield. So stablecoin, constraints, you get the set of protocols, you can look at the yield, and then I think you can make the risk assessment of the protocols. Sorry, that was maybe a little long.
No, it was well summarized. You got it. You know, I think it's helpful to have that framework. And okay, so one final question then. Well, actually, not really a final question, but just thinking about that framework you just provided, where, you know, you've got a way to think about, okay, choose a stablecoin, think about my constraints, think about a platform. I think there's a lot of noise around just how these things fare in volatile market conditions. And, a couple of weeks ago, did it Athena really depeg on Binance, or was it just an oracle that was set in a certain way, and so on? For someone who's outside the market, like, this all seems just very confusing. Where do you start? Is it, okay, I really trust that I've done my underwriting on DD on this curator, on the protocol, on the network? What do you, maybe you can just add a little bit extra there just to help people just to figure out, okay, where should they focus?
Yeah, for sure. I would say, unless you're a fintech who is using a new chain, or you're making your own chain, the base network should hopefully be the least due diligence you need. Like, hopefully it's like Ethereum, Solana, an L2 that's used a lot, like Base, or like an L1 that's been around for a while, kind of someone like Near or something. Someone where the validators exist and have survived a crash, and when there was a crash, the validators didn't all leave. That's like, to me, that's like, if you have that, then you know that the chain survives for a while. I think the protocols, honestly, I think, lindiness is obviously important, one of the most important things. I think the other thing that's important is performance over time, like, in terms of yield. I think DeFi was born out of trying to beat cockroaches from the 2017 crash, and like, how do we survive when Binance delists all these tokens? It's sort of a very weird way of viewing it, but it was built around this idea of like really, really low risk, but things still function. It's like super over collateralized, super ... right? Like Maker launched at 150% over collateralization. So, like, the protocols have survived the longest, generally speaking. I'm more or less worried about that, as much as I'm more worried about their performance or ability to scale. There's sort of a sense in which certain protocols just reach a terminal capacity, and then it required a new technical innovation to move to a larger scale. I think the perpetuals market is like that, where like there were tons of perpetuals dexes before, but like the hyperliquids and lighters of the world had to make a different set of design choices and technical changes to get to the volumes that they're at. So lindiness and TVL and volume and stuff, like, I think in lending protocols, there's not really wash trading because it's collateral expensive. Like, you're putting up collateral. So like, there's a huge opportunity cost of that. So you don't have to diligence that as much. Like, generally speaking, like the loans are real. There's not like wash fake loans and stuff. I think the main thing is like incident response and like community. Like, how much risk do you have from the community, especially if it's a DAO? Can the DAO add assets that are weird? Stuff like that is kind of important. But like, generally speaking, I think lindiness probably trumps everything else. And then on the curator side, it's like evaluating an asset manager, right? What's your track record? How well have they performed in certain events? What's their Sharpe ratio? Like, I really do think it's like that. But with the added caveat that their security posturing is extremely important. I think compared to being an asset manager in traditional finance, I don't really have to care. Like, okay, if I'm in quant trading, HFT, I do care about security a little bit, but I still mainly trust the data center, right? Like, I'm not thinking North Korea is going to break into my system and start giving bad allocations that make me lose money. But in crypto, that's a very, very real thing. Like, you really do need to care about how well they think about security, how well they think about stress testing, in a way that's a little different than a normal asset manager. I think, like, we've seen a lot of incidents with really strong trading firms in crypto who have had incidents where, like, they made really bad security issues. Like, they kind of got locked out of a multi-sig, or they malformed a signature. There's all sorts of like blockchain specific security stuff that if that no matter how good of a curator you are, if you don't do that, you will have problems. So that's the one thing I would say you have to add on. And then track record, how long they've been around crypto is important. And I do think one interesting thing, and certainly the thing that keeps me most interested in the space, is like research, writing, transparency, like people who are like constantly putting out content about what they're working on, I think is something different than traditional finance. In traditional finance, it's like a lot more, people don't publish stuff. They don't kind of like write stuff. But here, because there's already a bunch of forced revelation and transparency, you see a lot more writing. And I think the writing quality and research quality is actually extremely important. And in that sense, people evaluate asset managers based on that, but it's sort of a different type of research. So I point it out.
Right. That's helpful. And I guess as I think through it, it does seem still fairly quite complex. I'm thinking if I'm a fintech provider, fintech offering, and I'm listening to this, I'm saying, okay, I see the benefit. I see that there's all these options and ability to deploy capital in these really unique ways, but I think I need a bit of help. And I'm sure they can come to folks like yourself or to walk them through, okay, here we can provide a platform, a kind of a managed service for you to essentially to provide your users with these additional things. And then over time, the longer these things exist, the more lindiness there is, the more, every chance there's a crash or anytime there's a hack, people get better and better and the robustness builds up over time. And so I guess, what is the goal? What is the future of DeFi? Where do we see, 10 years from now, or even longer, we've got Robinhood, CEO of Latenov, and also BlackRock CEO, and now even JP Morgan CEO Jamie Dimon saying everything's going to be tokenized. And so if everything's tokenized, do things run on DeFi as it looks today? What is, if you wave a magic wand, what does it look like in the future?
I think the idea that asset allocators are algorithms and not groups of people manually making decisions is kind of the long-term dream. And like
agentic asset management.
Yeah, like in a lot of ways you sort of think of, in quant trading, everyone thinks of themselves as doing that, but they're not really in a lot of ways. Like there's still a lot of manual algorithm design. Let's put it that way. It's not like really, the either from the consumer side, the robo-advisor type of thing, or from the like higher yield hedge fund side, like strategy development. It's still kind of not really there. There's actually a very good podcast by Ian Dunning, the head of AI at Hudson River Trading, that kind of he does a good job characterizing this recently. But I would say that like there's a world in which, in the same way ads went from like I have an ad agency and I have to go hire an ad agency and they have all these people to like, there are all these people online just bidding on ads constantly, and like you want to be good at marketing, you need to know how to bid on those ads if you want to do it cost effectively. I think that transition for finance to 24/7 all the time, everyone needs to be an algorithm. Like you can't do things manually is the end state. Now, whether it's agentic in the way people are thinking of in kind of AI meets fintech right now, or whether it's more agentic in the way of like quant trading, that is where I don't know what the final state is. Like those are two actually quite different versions of automation for live 24/7 constantly optimizing systems that are competitive. But I think both of them will end up needing a common substrate, because I think the beauty of crypto is it can service the retail users and it can service the whale users all in the same substrate in a way that I think normal traditional funds and asset managers don't, for a lot of idiosyncratic reasons, but also a lot of reasons in that it's not you can't enforce a lot of covenants algorithmically in the way that you can in crypto. And I think vaults serve as these kind of like security enclaves. Like they let you encapsulate like certain operations that are safe and certain operations that are unsafe, and then you as an AI algorithm don't need to be like also have trained it to be like the security expert in that particular asset class or that particular type of thing. It can just think of like, hey, here's the high level description of this, and I have an algorithm that's allocating in and out of it. Right?
It's like sandboxed.
It's sandbox, exactly. It acts like this. I really like thinking of these. The goal of DeFi is like making these kind of hardened, safe sandboxes, and then the agents are just allocating across sandboxes and moving between them, right? And to me, that's where DeFi goes in the long run. Like I think like there's going to be large pools of liquidity. The sandboxes kind of serve as a way of like safely atomizing them and like giving you higher, better guarantees on yield or risk or whatever. And then there's the agents who can interact with those safely, and if they make a mistake, it's still okay. Versus like if I make a mistake, it's like I lost all my money, right? Like I think that's the problem with the current agentic AI finance stuff I see right now, is like the security and like quant stuff is very weak, and like you see all these tail cases where they could lose all their money. And I like the encapsulation that separates the like tail events from the average behavior. Like the agents should be doing the average case behavior, but they should have some security around the tail case stuff.
Yeah, I was going to say, I think we just kind of live whiteboarded, brainstormed a new startup opportunity, which is a kind of swarm of agentic investment asset managers. And we would call it Sandbox, if not for the existing project, the Metaverse project that exists from last cycle. Anyway,
maybe they'll pivot. Maybe they'll pivot.
Yeah, exactly. If they're listening, we can take we take royalties. Okay, this has been fantastic. I think so much to consume, so much to work through into our strategies and plans, but helpful to see what the opportunities are when we think about investment allocation, providing your users with investment choice in a safe way that's verifiable and you can withdraw at any time. And so as we close out, we just want to ask some quick fire questions.
Sounds good.
So the first one, if we project out 5 years from now, and I know we kind of just talked about this, but maybe it's a different answer. What does success look like for Gauntlet?
Honestly, I think it's, if I think stablecoins grow in TVL by 10x in 5 years, yield grows faster than supply. And this is just generally true in most markets because there's the money multiplier effect. Like once people are lending, that collateral gets reused, and then you kind of get, what you learn in like your microecon 101 class, that there's this money multiplier effect. And in a world where there's that yield, I think we just want to be the place that no matter what type of user you are, retail, whale, hedge fund, we can offer you a product that is safe, secure, and or AI agent, whatever, whoever you are. In fact, we have a bunch of AI agents depositing in our vaults right now, so it's definitely not zero TVL. But the goal is like we want to cover every part of the risk spectrum and every part of the yield spectrum, which will grow inevitably as stablecoins grow. It's kind of a, be the API for yield for whatever type of user. I guess that's like kind of the simplest description.
Nice. Okay, and separate from all this, what is your favorite book, movie, TV show, or other content?
I don't watch enough TV show or movies, so that one is probably out. I mean, I feel.
Oh, actually, you said already. You recommended the podcast with the head
Ian
of
Dunning's
AI.
podcast on Odd Lots, on HFT. I think there's, in terms of books, there's a very famous book from the 1920s and 30s that I was recently rereading called A Mathematician's Apology by G.H. Hardy. And it's a book about a mathematician who's like, I don't want to disrespect the sciences or engineering for like figuring out how to make math useful. But I want you to know that I only care about it because of the aesthetics and the beauty, and like the actual usage is not what I care about. And one reason I bring it up is I somehow feel like this is something I worry about in a world of like everyone using LLMs constantly, what is the sense of aesthetics anymore? Does it exist? And so anyway, I've been reading a lot of books that are like old people's ideas of that 100 years ago. So
yeah, it's like where's the beauty and the art of actually the craft,
the prompt,
the
the
design.
prompt typing. Yeah.
No, that's food for thought for sure. Especially with all the AI generated everything these days.
Everything. Yeah, exactly.
Okay, and then final question. Other than the head of AI at HRT, who else should we talk to learn more about DeFi, or just anyone else in the space?
Yeah, I think, I think someone who has an interesting worldview who kind of can bridge these is probably Christine Moy from Apollo, because she kind of, she runs digital assets there, but she's a very a dual lens of this, of like why a big asset manager cares about DeFi.
That's great.
So that kind of
great
seems
one.
like the right fit.
Yeah.
So.
All right.
Yeah.
We'll make it happen. Awesome. Tarun, this has been fantastic. I've learned a tremendous amount, and I hope the listeners have done too. Where can listeners go to learn more about you and Gauntlet?
Yeah, so I'm at Twitter, Tarun, Tarun, Chitra, Chitra, no space, no separation, all one word. And Gauntlet, Twitter at Gauntlet_XYZ or Gauntlet.xyz.
Awesome. Raj?
You can find me on Twitter or X at rparekh and mana.xyz.
And you've updated your Twitter handle, right, Raj? Like
I
that's a new
got
one.
lucky with the handles marketplace.
Right.
So check that out. It's still in beta right now, but I was able to switch my handle because of that.
So for folks who are like, every so often people listen to one episode and they'll go back and listen to old ones, you're going to see exactly when Raj acquired the solid handle. That's great.
That's right.
Okay, and for me, stablecoinblueprint.com for long form writing. Then you can find me on X, Chuk_XYZ, and then LinkedIn, Chuk Okpalugo. Thank you all for listening, and Tarun, thanks again for joining us.
Glad to be here.
Thanks so much for listening to Money Code. There was so much to take away from today's conversation. I learned a lot, and I hope you did too.
If you enjoyed this episode, do us a favor, share it with someone you know, or give us a 5-star rating on Apple, Spotify, or wherever you get your podcast from. Until next time.